typically what happens in the late stages, which is the stock market cycle where it says top here, usually we see precious metals, energy, industrial capital goods, and utilities actually do very well at this phase. And that's usually the last couple of weeks, last few months of the stock market before we go down. We have seen utilities just scream to the upside, dramatically outperforming everything else. Typically, when we see utilities move higher and continue to push higher, when the stock market is even rallying, this is a sign that big money is going defensive.
Chris Vermeulen is back. He is a chief market strategist at the technicaltraders.com, and we'll be talking about his early warning indicators for the equity markets and the asset that he believes has a lot more upside for the remainder of the year. This episode is brought to you by Masterworks, which has a very unique way of alternative investing. We'll talk about that, so stay tuned for a message from Masterworks. Chris, welcome back.
Hey, thanks, David. Always a pleasure.
Every month I have you on, and then I'm hoping there's some insane volatility that happens, because that's what viewers want. They want to find out what's going on. And it hasn't happened in the last couple of months. It's just been kind of calm. Can I use that word? Is that the right word to use?
It depends. Depends who you're talking about. I mean, the stock market had a pretty good pullback over the past month and a half, 2 months. So it depends on what you consider volatility. Nothing extreme. We're not seeing panic selling or anything like that. So it has felt fairly calm and controlled, in my opinion.
Yeah, that is right. And by the way, this pullback has more or less corrected to new highs. So what's momentum right now? Downside or upside?
Momentum's to the upside. The short-term trends are pushing higher. We saw the SP 500 and the NASDAQ futures both poke to nominal new highs yesterday, and a little bit of selling stepped in as soon as it hit. But the longer term trend is still trying to figure out in terms of, is this another leg higher that could last for several weeks or several months? We haven't got confirmation on that. We're potentially a day or so away from a new trigger in the markets, but we need to wait for confirmation, because yes, the markets are hitting new highs. The short-term trend is up, but we're not seeing a lot of confirmation actually behind the scenes. A lot of defensive sectors are actually outperforming the market dramatically, which is not a good sign for the overall stock market health. So there's a bunch of warning signs, and we need more momentum to the upside and more strength before we want to get back into the stock market, because we moved out of it just as it topped out a couple months ago.
Before we continue with the interview, let me tell you about another way that we can invest. Now, investors have a problem. Today, most portfolios include only stocks and bonds, and while that 60-40 strategy has worked in the past, it's also a strategy that Goldman Sachs has predicted in 2023 may underperform over the next decade. Luckily, our sponsor today, Masterworks, focuses on a non-traditional alternative asset, art, helping investors diversify a portion of their overall portfolios into blue chip contemporary art. Over 60% of wealth managers surveyed by Deloitte have already integrated art into their wealth management offerings. Masterworks' art investing platform offers blue chip paintings to investors in the form of shares. This way, if it works for you, you can diversify into multiple artworks while controlling the amount you invest. Some of Masterworks' previous offerings include legendary artists like Picasso, Basquiat, and Banksy. And if an offering does sell, you would receive the proceeds, if any. You don't need to be an art expert, and over 900,000 members have already signed on, with shares of some paintings previously selling out in minutes. But by using our special QR code on the screen here, or in the link down below, you can skip Masterworks' waitlist and invest right away. Okay, so let's talk about your early warning indicators. So you mentioned defensive stocks outperforming as being one indicator. What are some others?
Yeah, so pretty much when we look at those, I can share my charts here and give you a visual. So typically, what happens in the late stages, which is the stock market cycle where it says top here, usually we see precious metals, energy, industrial capital goods, and utilities actually do very well at this phase. And that's usually the last couple of weeks, last few months of the stock market before we go down. And so if we take a look at, for example, utilities, this is a very good sign. We have seen utilities just scream to the upside, dramatically outperforming everything else. Typically, when we see utilities move higher and continue to push higher, when the stock market is even rallying, This is a sign that big money is going defensive. They're worried about a correction. They're worried about the economy, and so we see big money slowly start to siphon money out of some of maybe their growth stocks and start to move into water, electricity, all of these companies that pay dividend. That no matter what happens in the economy, they're still going to keep going. So last time we saw a huge outperformance like this, believe it or not, was right before the COVID crash. Utilities had a massive rally. Now we've seen it many times before that as well, but if we were to just take a look at utilities in the COVID crash, you can see the last time we had one of these massive rallies to the upside. It was a bloodbath after that, and of course there was an event that sparked it. But I think the market was primed and ready for a big correction anyway, because we have seen utilities have a lot of big runs in the past, and whenever we see these strong runs to the upside, we generally see the stock market have a bigger pullback later. So this very strong run is very similar to each time we've seen a very big multi-week or multi-month correction in the market. So that is a warning sign. Precious metals are also in rally mode. They're starting a new leg higher, which you and I can talk about in a minute, but they're another one of these defensive plays that are saying, hey, we are in late stages. People are moving to commodity space into resource stocks as a play to take advantage of. Maybe the stock market is going to go under, but commodities should do well for a little while here. And of course, companies based around commodity pricing will do well, like gold miners, silver miners.
Okay, I want to come back to that in just a minute. But let's take a look at the VIX, Chris. Now, the VIX is currently at a multi-month low. Last time it's seen this level, I believe, was in March. When you see the VIX trending down to a monthly low or multi-month low, what does this mean to you? Does that mean that there is so little fear in the stock markets that it's prime for a healthy rally, or do you think to yourself, this is time for a reversion?
Yeah, so the general saying is when the VIX is low, it's time to go. And so when the VIX is low, just as you said, it keeps grinding lower and lower. That means people aren't fearful. There's not a lot of volatility. People are not jumpy. Before we had this spike in April, or during April, people were super jumpy. One little tiny pullback in the market, and we saw panic and people were dumping shares. But right now, there's no panic selling. People just aren't afraid. And without waves of panic selling and jumpy traders, the volatility, the overall price action remains very low. So this is generally a bit of a warning sign that the market is primed and ready. If no one's afraid of the markets pulling back, generally it's going to pull back. In fact, the put call ratio is another little thing I like to look at. It's not great for timing, but if we were to just kind of look at it, I like to follow the 5-day moving average on the daily put call ratio, which is this thin blue line. And the fact that it's down at a level here that's just telling us over the past more or less week, people are buying call options. The majority are buying call options. And that means they're not afraid the markets are going to fall. And in fact, they're buying lots of leverage, expecting the markets to keep going higher. So all of these little things, the general public is aggressive buying call options. I think the big smart money who understand things are frothy are moving into the big boring utilities because they want to protect their capital. They want to move into defensive plays like precious metals as well.
Mm-hmm.
So yeah, the VIX low, the put call ratio, 5-day moving average is fairly low, generally signals a market pullback just because people aren't afraid and they need a little scare.
I want to take a pause here, just ask you about something that's been happening recently. GameStop, AMC, meme stocks they saw a brief revival this past week as Redditor Roaring Kitty came back alive again. Let's take a look at what's going on with some of these things. Did you get in on any of this, by the way? Was this on
Nope,
your
I,
radar?
I didn't even know they came back to life. I don't follow. This is not my style of trading. I don't follow news, so I didn't even know it was in the news. But
All right, well, okay.
uh,
So look at that volume spike, and then look at that
yeah,
price spike, and then it just come crashing back down to earth. All these
well,
stocks. Would you be
yeah.
getting in now? Let's say just if you look at a chart and just ignore all the noise, ignore all the news and the Reddit hype. If something goes up in a straight line and then comes crashing back down again, and volumes died down, do you look at that and say, you know what, buy opportunity?
No, not at all. I think it just probably, I mean, I don't know what the news is around it. It's a pop on news and everybody trying to get it on the next social media squeeze, whatever it is.
Well, that's exactly what it is. Yeah, you summarized it quite well for us.
Yeah, so it's just to me it's just a pop and drop. It's just everybody piles in. They want to try and make their quick fortunes because we haven't had excitement like this obviously in a long time, and so everybody's quick to jump. They're jumpy on this type of stuff, the aggressive traders. But to me, it could just fade down and be done. I mean, we've seen this happen in so many different stocks, unless there's something that can build more momentum behind it. But at this point, that is just a news driven event. And hopefully you weren't the one, anyone wasn't the one buying it at $11 plus.
I mean, that volume could be selling. Who knows? Um, yeah, you'd want to get in early on this, otherwise it could be pretty painful. Chris, what is your overall target for the S&P 500? Do you have one for the for us for the next couple of weeks?
Yeah, the SP 500's got some half decent potential here. I mean, we could use Fibonacci extension to get an idea of where a conservative upside target would be, and I'd probably use these lows right through here, this high, and this low. And this tells us the overall momentum of the market. So based on the run that we had from here and then this pullback, it's telling us we should find resistance at the 618, which is that's right where we are now, which is also a double top. So I would not be surprised if we have some type of pause or pullback here for a few days or a week or so. If we do have a controlled pause here and it doesn't just crash and fall out of bed, then we're probably going to go up and hit this next upside target, which is about 57.50. Based on today's price of you and I talking, it's about 5% to the upside, which isn't huge, but it's not bad. And that could, play out over the next 1 or 2 months, which actually falls in line with what usually happens in the precious metal space. We'll generally see them come to life and have some very strong gains for 1 to 2 months, while the stock market potentially pushes to a top or starts to trade sideways here. So the SP 500 has got upside, but it is definitely at resistance, just based on pure momentum from the fib level, and also because it was a high from back beginning of April.
Are you seeing the same momentum in the large tech stocks as last year? In other words, do you think that the Mag 7 stocks have fuel in them to drive the entire index up once more?
Um, it's tough. Nvidia's coming up towards kind of double or triple top phase. It'll be interesting to see how that goes, but a lot of them are really struggling. Like when we look at Apple, Apple had a huge move up. Simply, they got tons of cash. They're doing like $110 billion share buyback, which
Mhm.
jacks the price up. And so that's got some momentum, but it feels like it's into resistance. I really feel like when we look at the bigger picture of Apple, let's zoom out quite a bit here. It's getting up into resistance. It's definitely struggling. We've got like Tesla not looking so great. I mean, all of the big techs have had a big pop really around the same time, but Tesla's moving down. If we take a look at Microsoft, Microsoft is pushing up near these highs. It's a real mixed bag, but we're definitely not seeing the large caps have the momentum that they had, a few months ago. It feels like they've stalled out, and they're gonna. I don't think they're gonna drive the markets up huge again. I think really it's just going to be a slow grind for this market to move higher, because the big seven, they're all really mixed signals, and everything is now pushing up into resistance. And a few of them really were just big pops on news. And I usually those fizzle out over time, like Apple and Tesla and things like that. So I'd expect that momentum to stall. And if those two big companies want to go down, they're going to mute the market quite a bit on their own.
I wonder why the tech stocks aren't doing, or some of them aren't doing as well this year versus last year. Is this a micro issue, meaning these are company specific issues that, like you pointed out, um, need to be resolved, or perhaps the overall market is losing momentum, and this is just a symptom of that issue? What do you think?
Yeah, I kind of feel like I feel like just it's running out of momentum. Like there was a huge AI wave, and that sparked everybody to want to get back into technology, and because those are technology companies, they move the technology sector up, like the XLK ETF. So it got people jumping back into technology across the board. I feel like it's running out of steam. Like we see AI in absolutely everything. It's kind of lost its shine now. If something comes out and it doesn't have AI, you'll be like, huh, surprised that doesn't have AI.
Yeah.
So I feel like that little bit of a momentum push has kind of fizzled. So we'll have to see. I mean, we saw the Nasdaq and the SP 500 struggling in terms of the Nasdaq is kind of underperforming the SP 500 when we look at it for, I think, the year. And that's a sign that technology is running out of steam. If the SP 500 is kind of leading the way higher, which is a little more broad market, so that's I think it's had its big move. Let's just take a look at like if we look at XLK here. I haven't done
Yeah.
this yet, but let's just take a look at the Fibonacci targets here. There is still some upside potential on the tech space based on this big run, this big bull flag. Whoops. To the upside, let me just grab this tool. We still have potential for about 7% or so in the tech space. So there is room for the overall markets to keep pushing a bit higher.
Okay.
But I don't see the tech becoming a huge driver like they were, I think, in the last 6 months.
Okay. I want to talk about gold now. Before I do though, gold has been outperforming stocks, so we're going to spend some time talking about gold today. What makes you unique as a trader? Let's talk about your style before we apply that philosophy to your gold analysis. What's different about your style versus some other traders on the street?
Right. So, I mean, I do things a lot differently. I actually happen to have this hierarchy chart up. So, I do a strategy called asset revesting. So, instead of buy and hold and just riding the roller coaster, it takes you decades and decades to retire, or being an active trader and generally struggling to make money. I do something that's kind of in between, and I focus on this asset hierarchy, meaning I always want to own whatever the asset higher up on this list because it has more volatility, which means we can make more money. It means it moves faster. And if that asset falls out of favor, we go down this list to look at the next asset class, and if they meet our criteria, we move into that. And so, I mean, just like Warren Buffett, he avoided technology stocks forever. He didn't get into Apple until feels like the game was over. Microsoft, he skipped out on. He wasn't big into technology because he didn't believe in what they're doing. He didn't fully know what they were doing. As smart as he is, he just didn't want to get involved in them. He always stuck with a strategy in companies in assets that he knew and understood. And of course, he's one of the wealthiest people. And I have followed him for a long time. And that's how I come up with this asset hierarchy is I know these things inside and out. I focus on being able to navigate them and I rotate my capital. 100% of my portfolio goes into one of these assets at any given time. I don't want to be diversified because all that does is give you an average return. If you're diversified, you're going to have winners, you're going to have losers. They neutralize each other, and you end up with a really poor overall return. And this way, this strategy allows me to identify, hey, okay, right now, this is in a trend. This fits our criteria in our risk model. Let's move into this asset and we'll ride this asset until that trend comes to an end from a technical standpoint, a momentum, intermarket analysis. I like to know where money's flowing between different asset classes. And so this is kind of how I do it. It seems slow and boring, but it works exceptionally well. And you can manage like unlimited amounts of money because these are big ETFs. They have to fill your order, and there's lots of liquidity anyway. So that's kind of how I do things is just rotate from one asset class at a time, simply because one asset's always going to be better than the others. And we just want to make sure we hold whichever asset is going up.
Someone told me a long time ago that people who don't diversify are either really confident or really stupid. Now, I've known you for a long time and you're not really stupid. So, how are you confident that this particular trade is going to work out well? In other words, what indicators do you look at to know that if it's not working out, you get out early?
Yeah. So, I mean, like an example of how we do it. So, the nice thing is, what I do is I follow technical analysis and position and risk management. And I don't try to predict pricing. And this is where a lot of people get things wrong. They're like, oh, you're technical, you're trying to pick tops and bottoms, you're trying to guess where it's going. That's not true. If you're to me, a true technical analyst uses price and you follow the trends. So we're not trying to pinpoint when it's going to turn. I don't care when something turns. I just want to know when it changes direction. Does it have strength behind it? Do we want to get in on it? Or does it turn down and have a lot of weakness? Should we get out of it? And like, for example, like during COVID, we have this is kind of our hierarchy of the three positions we rotated through. SPY gave us a sell signal, and we moved into bonds because bonds were in a strong trade, and they moved like 19% in 9 days, hit our max target at 15%. And then we moved into BIL, which is a cash position. As we move down these assets move slower and slower generally. And we just earn interest and sit in cash while everybody was panicking. And then we were able to rotate back into the stock market after it's put in a bottom. We have confirmation that big money is flowing back in. They want to be risk on, and then we can ride the market back up. So we just rotate from one asset to the other. And because we follow price and we use position and risk management, position sizing, and things like that, um, we're very confident that if something turns down, we just get out of it. We're not going to hold it and take a huge hit. And we have very tight stops in our strategy. And I mean, that's one of the reasons why if we were to look at our overall kind of strategy here compared to, for example, even the NASDAQ or SP 500, this top line is my strategy, which I call the CGS. It's the consistent growth strategy. It just consistently moves up, slow and steady. It's like watching paint dry. But from the 2008 market top, we're still outperforming the NASDAQ, crushing the SP 500 and the buy and hold portfolio. I mean, it's such a slow beast. I can't stand the buy and hold because all you do is you dump your money in and you're diversified, and it takes you decades and decades to make a ton of money. It's just a tough strategy.
Yeah.
And of course, you ride out 30 plus 40% drawdowns. And I mean, the strategy that I focus on, which is the CGS strategy, our max drawdown is less than 6%. A lot of people will take a 6% hit in a day. I mean, this is like our worst case scenario at this point with our strategy, because we manage our positions and break our portfolio down into sections. So this is why we're confident in what we do, is because we actively manage our positions, and we're trading and identifying trends that are solid, that are strong, and we're riding the coattails of what I believe are large institutional players that are creating these trends. So you just have to follow it right on their coattails, right in their wake. You just have to know how to identify those.
Some traders have more losers than winners, and how they make money is by position size. So the few winners that they do have, they're probably more confident in. They have larger position sizes than those, and the gains in those winners overrule, or I guess make up for the losses on those other losers. Are you one of those traders?
I mean, we win about 73% of our trades.
Okay.
Our losers are sometimes a little bigger than our winners, but we win more trades than we
I
lose.
see.
It really just depends on how things go. But yeah, it comes down to managing your losses. If you can cut your losses quickly, if you don't have any big losses, you don't have to swing for the fences to try to make it back. And so we do cut our losses quickly, and we just keep hitting first, second base hits over and over and over again, and it just slowly keeps stacking onto our portfolio. And the nice thing is now with that 5% more or less interest, we can move out of the market and still earn 5% return a year, paid out on a monthly dividend, which is a lower tax bracket as well. We can keep growing our account even while the market's going sideways. So we're sitting in cash right now. We were hitting new all-time highs with our investment account. Even while the market is going down last month, we were hitting new all-time highs. It's pretty amazing when you rotate through these different assets, simply, only holding things that are going up, which is key.
So you go all in on the one thing that you think will do the best over the next couple of weeks or whatever time horizon you've assigned. Is that how it works?
Yeah, yeah.
Okay. So is gold that thing for you right now?
Gold's for a different strategy. This hierarchy, we don't manage. We just focus on stock, bonds, currencies.
Okay.
That's what that is. When it comes to a different type of portfolio, yes, precious metals to me are probably the best play right now. I like them. They're coming to life. They're moving up. Definitely, I have a lot of physical metals, so I think we're going to see gold and silver continue to run. I think gold's going to go 2650 probably in the next month or so. That means miners are going to move up. Silver is going to scream higher as well. And the more they go up, to me, the more bearish I become on the overall stock market, because this is one of those last indicators. When this comes to life, generally the stock market is about to roll over to a recession.
Yeah, that's one. Okay, that has happened before, Chris. But let's take a look at gold versus the S&P. Excuse me. It's getting chilly here in Vancouver. Let's take a look at the gold versus the S&P 500. All right. Now they've both moved up at the same time. So, I that's my question. Why would you be bearish on the S&P when gold is doing so well? I mean, this year they've both moved up. Now the gold price has outperformed the S&P 500. Gold's up 17% year to date, and the S&P is up 12%. But you could theoretically be in both still and do well going forward. No?
For sure. Yep. Yep. I mean, yeah, it really comes down to your time frame, right? So for example, yes, you can hold the both. If we look at our investing strategy, which is based around the SP 500 on the weekly chart, we had a buy signal um, uh, early last year, and we're still long. So a long-term and longer-term investor, from a technical standpoint, we're still long this market. From when you step down to a shorter time frame, like that's when we start to look at what these other sectors are doing, and these other sectors and commodities coming to life are just a warning sign for more or less this long-term chart. We're probably going to enter some type of bearish phase. I believe we're going to eventually see something big. The market goes, as you and I've talked before, you got a rising tide, which you want to be long the stock market. You got a falling tide. You really don't want anything to do with the stock market. You want to move somewhere else. Well, the stock market fell like 25% last year. The US dollar ETF rallied 17%, which we were long for some of that. So you could totally be long both. A lot of people break their portfolios up into different strategies, different time frames.
Mm-hmm.
And so it really just comes down to the time frame that you're trading in order to know which assets you want to hold.
Stocks then, the gold mining stocks, do you think they have more momentum still? I mean, which category are you putting these assets in? Are you lumping them in with the rest of the stock market and saying, well, it's time to be cautious, or are you lumping them in with the gold market, which is to say that you're more or less still optimistic?
Yeah, so this is another confusing wild card. A good example of how we need to try to navigate miners here. If we were to go back and look at miners in different phases here, for example, this bottom chart along the bottom, this green section. This green section tells us we want to be long the stock market. The stock market is generally moving up in that phase. And gold miners really traded sideways or lower. And then when the stock market was out of favor, you don't want to hold stocks. Gold miners put in one of the biggest rallies we've seen in a long time. And this is the problem with gold miners. A lot of people don't get this is you never know when gold miners and silver miners are going to disconnect from the overall broad market. Typically, if we have the stock market in red on this bottom indicator, you don't want to hold any stocks. But utilities and precious metal stocks can completely go in the opposite direction, and you just don't know when that's going to happen. If we look at the current price right now, we've got the stock market saying, "Hey, we don't want to hold stocks." Yet gold miners are pushing higher. Same with gold and silver. So they're disconnecting and they're moving up higher. And so yeah, this is a phase to hold. I think the miners, and there's quite a bit of upside potential. We can use Fibonacci extension to get an idea of the overall target to the upside. And with just GDX alone here, obviously, if we move to the juniors, percentage wise, there'll be more. There's roughly probably 5% over the next few days, and then it's got potential to rally about another 15% to finish this move. So there's still quite a bit of upside potential in the ETFs. Obviously, individual gold miners could move 2-3 times that just because they're more volatile.
Would you short tech stocks and long gold miners? Would you make that pair trade?
No.
Okay.
That's just, yeah, it's not my style. I mean, I used to do stuff like that, but I don't do that anymore.
All right. Okay. All right, Chris. Well, thanks a lot. Give us one more asset that you're following right now that's of interest to you and perhaps my audience, and then we'll close out there.
Um, I really like the uranium space. I am very excited for long term. I really think this chart doesn't go back far enough, but URA ETF. I believe, when I look at the monthly chart, I was just in the UK in London for a climate and clean tech summit. We are keynote speakers for the movie that we're doing, talking about embedding climate education and clean tech into movies to educate the world. We've got this whole downward cycle, and now we've got this big basing formation. And the crazy part is, as much as the majority of people think uranium is dangerous, nuclear plants, it actually might be one of the best ways to get fill the energy void that all these countries need.
Mhm.
There's a major energy crisis going on, and nuclear is not that bad at all. It can produce a ton of relatively clean power. And so I do think it's going to come back to life. So this to me is going to be something very, very massive. I think when if we have a recession in the markets and the markets cleanse out, this will be one of the spaces that I think has got potential to really, really scream. I mean, it's bullish right now. You could still be long it.
Yeah.
It is breaking out. So I like this space, and I think it's got long-term potential that could last many, many years of higher pricing as we unfold through, the economy over the next 5, 10 years.
Fantastic. Chris, well, you can turn your screen off for this last section. I just want to ask you about where we can find your work.
Sure. Yeah. They can go to thetechnicaltraders.com. And that's where I share videos. I walk through the charts just like you and I did, but on a much more granular level. And pretty much I share every trade that I do. All the strategies, the strategy that I share is, what I trade with my own money. So it's not that I'm just firing out trades. I follow the markets. I use it for my own money, and it's very educational. And it's nice to have a pulse on the market, to know when there's panic selling, because usually when there's panic selling, I find the individuals are also panicking. And so if I can soothe their mind, saying, "Hey, this is normal. This is what we should expect. This is actually a good thing." That's what I share there, and my trades are based around ETFs.
If tomorrow, let's say you had all the money you ever need in your life, $47 billion, whatever random number that may be, and you could just do whatever you want for the rest of your life, would you still trade?
I would still trade. Yeah, it's what I do. I love it.
Would you spend more time doing something else and then maybe just trade on the side, or would that still be
Yeah,
your?
yeah. Well, yeah, I'd manage my own portfolio.
Yeah.
And I would probably go into inventing things. I love to build and make things. I'm
Cool.
really big into technology, electronics now, so I'm learning to program and build all kinds of stuff that moves and does
Really?
stuff. So
Okay. Wow, you're a man of many talents. I didn't know that about you. First, a movie producer. Now you want to be a Thomas Edison. Okay. We'll keep tabs on that development. Thanks very much, Chris. We'll see you next time.
thanks, David. Take care.
Thank you for watching. Don't forget to like and subscribe.